Depot, Walmart, Target.
But I think some of these names on this list, I mean, not to detract from the potential for these names to go up, but I think these are names that a lot of us have already owned. And so I think about this as the secondary layer. Like, what's the next layer down in areas like financials or in areas like, big box retail that could potentially benefit? So is that the regional banks? Is it Ross stores? Because if we're actually looking at this as fueling global growth and potentially being a catalyst for greater growth globally and here in the United States, I think there's a secondary derivative of these names that many of us have owned already. I think we need to kind of expand our universe and our purview to that second layer.
And to that point, look at the gaming stocks, what they did yesterday. I mean, that was really crazy. Like Wynn and Las Vegas Sands, Melco. Yeah. I mean, those stocks are under-owned, underappreciated, and still pretty cheap, too. So there's plenty in consumer discretionary.
So what I would say here is, we're talking about a bunch of names that are trading at the upper end of their historic valuation ranges. They are well-owned, as you well point out, by a lot of institutional and individual investors, but for good reason. I mean, these are higher quality companies. Look, when we think about the more cyclical plays right now as we go into 2020, we want to own some more cyclicals, but we want to own higher quality cyclicals. We've actually sometimes called them wimpy cyclicals. We don't really want to reach into the kind of the deep value that really requires a meaningful improvement in global growth, and that's kind of second derivative of growth to pick up next year. Our expectation is we are so far from recession. We're going to have a solid year of economic expansion, but that the winners are going to continue to be the winners, and that you're not going to get these smaller business models or companies that have otherwise been impaired or have structural challenges all of a sudden be able to reassert themselves in kind of a more stable growth environment. I just want to come back to the dollar because this came up before Trump's comments. I think there's a lot of concern around whether or not the dollar will appreciate and if that's going to have a headwind for emerging markets or some non-U.S. equities that people have started to dip their toe into. Our expectation is for a more stable dollar at this point. I don't think you need to see a depreciation in order for some of these non-U.S. equities to perform well, and particularly emerging Asia, which I think from a growth perspective and from, in some cases, a turning inward perspective, focusing on their domestic markets instead of the export and international markets will be really critical.
But that'll help the multinationals as well, right?
I believe, yeah.
They've already restructured. They've already taken pricing. They've already gotten hit big time from currency. So if that just stabilizes, that's a nice tailwind for them.
It should be great for them.
And their valuations are still pretty attractive.
You look at this list and you say to yourself, where do we go from here? You look at technology and think about the performance year to date, not just from the FANGs, but software. So many components, cybersecurity, technology from a weighting capacity is going to guide you where the market's going to go in 2020. Additionally, financials, they are going to be your indicator from a sentiment standpoint. If technology and software comes out in 2020 and begins to underperform, there's your concern. If financials begin to underperform, there's your sentiment concern. Those two sectors are incredibly important to the path for 2020.